But the truth is, I'm almost commodities agnostic. If you give me a tier one world-class ore body, I almost don't care what they produce. I'm very sanguine about making money in sand and gravel if that's what it takes.
Rick Rule is the founder of Global Resource Investments, president and CEO of Sprott U.S. Holdings, and has originated and participated in hundreds of debt and equity transactions with private, pre-public and public companies across the resources subsectors of mining, energy, water, utilities, forest products and agriculture. Joining me to discuss all that and more, plus get his forecasts for the year ahead, is Rick Rule. Rick, welcome to TCN TV.
A pleasure to be on your network. It's been too long since we saw each other, as my memory serves me, about a decade ago in London.
That's exactly right, at Minds and Money. And don't we all wish that we were back face to face, but here we are via Zoom.
Well, I look forward to face. That'll come.
Hopefully. Look, in the meantime, the mining sector is still just as exciting as ever. And this year certainly has been a roller coaster year on financial markets. Rick, can you let me know, how have your own investments performed, and perhaps what were your biggest surprises this year?
I don't think I had surprises this year. It's performed very well. My surprise was that the pleasant surprise didn't come earlier. At Sprott, we worked through the whole decade between 2010 and 2020, preparing for a recovery in resources, because bear markets are always the authors of bull markets. It took longer to occur than I had thought, but the fact that we prepared for it for 10 years has meant that this year has been very, very pleasant for us. As I say, to me, the surprise was only that it took so long.
That's very good to hear. I mean, I suppose in terms of looking more specifically at commodities, were there some that you felt were performed more strongly than you had even prepared for?
Not really. What did surprise me was the strength in the junior mining sector. In my experience, bull markets and resources have taken a very predictable path, led by the material, then by the biggest and the best, the large companies, and then coming down the quality trail, to the large intermediates, all that kind of stuff. And then finally down to the penny dreadfuls, the explorers and the developers that we all love so much. In this particular case, market leadership went from the biggest and the best down to the bottom right straight away. May or June, July of this year, certainly in North America, saw junior capital markets become really, really frothy, and overvaluations became rife. And I hadn't seen that occur early in a bull market before, but I guess if you live long enough, you get to see everything.
Absolutely. Now, Rick, as you mentioned, listed mining investment opportunities really do range from those very highly speculative ones, such as explorers, through to really the big guys with their operating mines. What sorts of mining stocks do you recommend to retail investors?
The truth is, there's no one size fits all. My belief is that if you're a real contrarian, you are early into every commodity sector. You're there when other people don't want to do it. And traditionally, you are rewarded there by buying the biggest and the best for two reasons. When the commodity turns, it's the large, high quality stocks that move first. But also the large, high quality stocks pay a dividend. So if you are like me, characteristically 2 years early, the only way that you get past the time value of money risk is by the dividend yields inherent in the biggest and the best stocks. Having said that, speculators who are willing to do the work in smaller companies can generally outperform the institutions and the broad market by doing work in riskier names, provided that they have the psychological and financial staying power to do it, and provided that they're willing to do the work.
Now, you've recently highlighted the problem of investors adding too many precious metal stocks to a portfolio. What do you see as the drawbacks of retail investors over-diversifying their portfolio?
The truth is, with regards to juniors, there's probably 2,000 juniors, listed juniors worldwide. The problem is maybe only 300 of them are viable. And the probability that acquiring stocks at random, owning too many stocks and not knowing enough about the individual issues, is that you own too many guaranteed losers. We ask clients to own the number of speculative stocks that corresponds with the number of hours per month that they're willing to spend studying their stocks. Read the annual reports, read the proxies, read the quarterlies, read the resource estimations, read all of that stuff. If you're not prepared to do it, buy yourself, some broadly based resource index fund and call it a day.
So there really is nothing really that beats doing your own research.
Of course not. Of course not. If it's important for several reasons. One reason is that it gives you the confidence in your investment. Many investors in the market that we're going through right now, where the juniors are off by 25 or 30%, if they don't have enough confidence in the work that they've done, lose faith in their investments and sell them for losses when it doesn't need to occur. The truth is that there are numerous cyclical declines in a secular bull market. And down moves like the one that we've suffered through, we will suffer through again. That's the nature of the market. If you know your stocks and you have the courage of your convictions, you will welcome lower share prices so that you can add to your position at better prices. But if you haven't done the work, if you don't have the courage of your conviction, you're very likely to be shaken out of a good stock at the wrong time, at the wrong price.
Now, Rick, you do mention that downturn that we recently had in markets, but folks are now getting pretty optimistic about a global vaccine for COVID-19. What would be the upside now in buying physical gold or gold stocks when everyone's feeling so bullish about the future?
I think people's faith about the future is faith in a fact that doesn't matter. I don't think it was the COVID-19 virus that increased the gold price. I think it was the government's response to the COVID-19 virus and the government's response to other fiscal difficulties that led to an increase in gold price. Gold prices in my life have increased when people are afraid of the purchasing power of their savings in conventional instruments. So things like deficit spending, which by its nature debases the currency, or debt and deficit, which calls into question the credit quality of governments and banks, but most importantly, negative interest rates, are the things that drive the gold price. And I believe that even after a vaccine is developed, if a vaccine is developed, which I'm confident it will be, that is efficacious against the disease, that governments will continue to counterfeit, which is what I call counterfeit quantitative easing. And they will continue to spend more than they take in, and they will continue as long as they are able to maintain interest rates at very low levels. So I believe that the wind is in gold sails, really for a substantial period of time. I think the antidote to higher gold prices is responsible politics. And I don't see that on the horizon.
Rick, I do understand you have always been a fan of gold. However, many market commentators are now saying that gold's role as a store of value will be taken over by Bitcoin. And I'm interested to know, really, your perspective as the value of fiat currencies continues to be eroded and the price of digital currencies continues to rise. How do you think gold will be impacted?
I think they're complementary assets. Bitcoin may compete with gold around the edges for speculators who like volatility. It's interesting that Bitcoin is substantially more popular now that the price has doubled than it was when it offered better value, which says something about the nature of the crowd that's hanging around Bitcoin, although the same could be said for gold, actually. The truth is that gold's market share around the world as an asset class is very, very small. In the United States, the market share for precious metals and precious metals related assets is less than 0.5% of total savings and investment products in the world. The competition for gold is not Bitcoin. It's S&P 500 index funds. It's equities. Gold and Bitcoin can operate in separate silos within alternative classes and not conflict with each other at all.
Well, that's actually a surprisingly harmonious view, because I think generally people are in one camp or the other, but you've really presented something in itself, I think, a bit more contrary. And really, looking ahead for the year, when it comes to resources, which commodities do you think are really positioned to perform the best? And perhaps how have you adjusted your holdings heading into the new year?
I think risk to reward in the near term, the wind is in the sails of precious metals. So gold and silver and precious metals equities. That being said, I'm a contrarian. I look forward 2 years or 3 years with my contrarian hat on. The last 2 weeks notwithstanding, I think uranium is a spectacular speculative asset. Truly spectacular speculative asset. Less attractive now than it was 3 weeks ago before the share prices all went up by 30 or 40%. And then in terms of the investment part of your portfolio, I think oil and gas is an absolute no-brainer. Greta notwithstanding, the truth is that your listeners believe, I think, that 5 years from now, when they leave their bedroom, walk to the garage or the carport and turn the key to the right, that the car is going to start. That means that they believe in oil prices that are high enough to let the industry earn its cost of capital. It is true that the demand for petroleum products will decline over 15 years, but supply is declining very fast as a consequence of constrained capital expenditures. So in the 2 to 3 year time frame, the real no-brainer for me is oil and gas. But in the nearer term, gold and silver.
Okay, Rick. And look, here in Australia, as you know, mining makes up a significant part of the Australian Securities Exchange. As Sprott is clearly across it, having invested in precious and base metals explorer and developer Adriatic Metals mid this year. I was wondering what attracted you specifically to this company and what your thoughts were on it.
Well, for myself, I've known the management team, I've known the people around the company for a very long time and felt some comfort there. I am also attracted to grade. And we saw from the earliest drill holes that this deposit was an outlier in terms of grade. Other punters in other parts of the world are more concerned, about perceived political risk. The fact that they couldn't spell Bosnia was a concern to them. I've been a global investor in extractive industries for 40 years now, and I have learned to fear technical risk more than I fear political risk. All of those things coming together, we made the decision early on that we believed that the genesis of the deposit was a massive sulfide deposit, and those deposits usually occur in clusters. And so I don't believe, I shouldn't speak for Sprott, but I don't believe that the potential ore body that we've discovered is in any way, shape, or form the end of the exploration success that may be enjoyed by Adriatic. It's important for your listeners to know that Adriatic is an exploration stock. It's a speculation. It's not an investment. And so you engage in something like Adriatic with money that you can afford to lose a substantial amount of, and also you engage in it with a mindset so that the volatility associated with the Adriatic share price doesn't scare you out of a position that you shouldn't otherwise exit.
Rick, they are, of course, focused on silver and zinc. Could you give us perhaps your outlook for how you expect both to perform in the short to long term?
I believe that zinc demand will be constrained because I think that my own economic outlook for the next 3 or 4 years is gloomier than many other people. My experience with regards to silver, however, is that silver moves after gold, but after momentum has been established, silver moves farther than gold or faster. But the truth is, I'm almost commodities agnostic. If you give me a tier 1 world-class ore body, I almost don't care what they produce. I'm very sanguine about making money in sand and gravel if that's what it takes. The fact that this happens to have silver is for me a bonus.
Okay, Rick, and final question. Looking ahead in 2021, who are you picking as the big winners in the resources sector?
I think the big winners probably come in the uranium sector, but I think if you juxtapose risk to reward, which is a very different circumstance, that investors need to be in gold and silver equities, particularly Australian investors, where your homegrown industry is so strong and where you have an informational advantage relative to investors around the world who will come to Australia in the later stages of the market.
Well, we certainly look forward to having you in Australia as well, as soon as these borders do open. Do you have any final thoughts or guidance for investors out there?
I do. We've been active in Australia for 40 years, and biology willing, we'll be active there for another 30 years. And I love to engage in dialogue with Australian investors. So here goes my pitch. In order to facilitate that dialogue, any of your listeners or subscribers who go to a website, SprottUSA.com, SPROTTUSA.com/rankings, you'll find a form. And if you enter your natural resource stocks, names and symbols on that form, please, by the way, no cannabis stocks, no technology stocks, no things I don't understand, resource stocks only. I personally will rank them 1 to 10, 1 being best, 10 being worst. And I'll comment on those individual issues where I believe my comments might have value. In addition, if in your request you mention charts, I will include by return email the Barron's Gold Mining Index chart, which goes back 50 years, the best visual aid to the anatomy of a bull market that I've ever seen, and a 100-year commodity chart, which will show just how cheap real commodities are relative to other asset classes going back 100 years. There is no Australian that I can think of that shouldn't have this commodity chart, given how important things like iron ore and coal are to the financial future of all Australians.
Well, Rick, thank you so much for your insights today and all the guidance for our listeners and investors out there in the mining sector. And I hope that your 2021 is just as, if not more prosperous than your 2020.
That's very kind of you. I hope that the holiday season is good. I hope that Santa, despite COVID, will come to the Southern Hemisphere this year and treat you well. And I hope that you will stay safe until a vaccine comes to you. I look forward to seeing you at, I don't know, Diggers and Dealers or iMark or something, somewhere, sometime.
Absolutely. We'd love to get you at any one of those. So all the best till then, Rick.
All right. Thank you.
And thank you for watching. Now, if you like what you see, please be sure to like and share the video, subscribe to TCN TV and drop us a comment. Tell us who you would like to see next and what you would like me to ask them. Or if you're an investor, send us an email so we can keep you in the loop with the latest ideas to empower.